Hello and welcome to the International Investment, Cryptocurrency and Fintech Spotlight. With me here today in our studios here in Covent Garden, London, is Jason Guthrie, Head of Digital from WisdomTree. Welcome, Jason.
Morning, thanks for having me.
Jason, we're going to go through a few questions. You can tell us a little bit about your proposition over at WisdomTree. But first things first, tell us what your role is. Just give us a flavour of what you do on a day-to-day basis.
Sure. So my role is I'm head of digital assets for WisdomTree here in Europe, and I have a few responsibilities. I sort of oversee and coordinate our efforts around crypto access products. So we have Bitcoin and Ethereum products in the market at the moment. We're looking to expand that. So working with product development on bringing new products to market, working with research and our thought leaders on kind of content and educational pieces that we put out, and working with sales on kind of client engagement and education as well. And then I have some other responsibilities around the firm's sort of strategic interest in blockchain and crypto. We have a few strategic investments that we've made that I'm involved in, and we have a few interesting projects in the world of tokenization and sort of direct-to-client blockchain initiatives, and I look after those as well.
I mean, immediately speaking with you, it sounds to me like you've got quite a lot on your plate, in a growing area as well.
Yeah, it's a very interesting time to be involved in crypto and digital assets. It really does feel like the space has hit somewhat of an inflection point, going from being this sort of technological curiosity on the sides to really starting to gather momentum and move into the mainstream.
Can you tell us about the digital assets market? It's come from nothing to where it is today, which is very firmly in the spotlight. What are the long-term trends that have contributed towards that?
So I think it was really sort of a convalescence of a few things that set the scene and enabled this to really grow to what it was. So firstly, there's the technology element of it. And we really needed the technological building blocks to enable this to happen, right? So the internet is an obvious one, smartphones in everybody's pocket, social networking, so the idea that everyone's going to be connected through the internet becoming mainstream, and the concept of decentralization becoming, people becoming more confident with it. And that really started with kind of cloud computing, and that's become a huge topic now as well. So these sort of form the building blocks that enable crypto and decentralization. There's then some social trends that have helped contribute to it as well. A lot of people now that are adults don't actually remember life before the 90s. And so what people expect, the digital native experiences they expect from everything they interact with, has really raised the bar, and money, financial services haven't kept up with that. So there's a push from society to kind of move in a direction of this. And then there's some political ones as well. We've seen sort of economic mismanagement in some parts of the world, think about Venezuela, and we've had environments in the majority of the world which are continual printing of money and zero interest rates. All of this kind of comes together to form sort of the perfect storm to birth this as a technology for the drivers for people to develop it, and then serve as the catalyst for people to pick it up and adopt it.
So the digital assets market at the moment is close to US dollars 3 trillion in market value. What events over the last year do you think have been the most pivotal in the digital assets market reaching this high watermark?
So it's been quite an eventful 12 months in digital assets. We saw sort of huge increases in corporate usage of cryptocurrencies generally. This might be companies holding Bitcoin on the balance sheet. MicroStrategy, Tesla are kind of the two biggest names, but there's a big, deep bench of sort of medium-sized companies that have been doing it as well as companies like PayPal, Visa, Square getting into crypto or saying they're moving into crypto, enabling settling of transactions on their networks in stable coins, allowing people to hold crypto in their PayPal accounts. These type of innovations, I think, have been really big in bringing it sort of to the forefront, to the mainstream, and sort of making crypto much more visible. We've seen big advancements in the technology itself. It's always continuing to innovate. The rise of decentralized platforms, alternatives to Ethereum, has been a big story this year. NFTs, if you're following the space at all, you'll be familiar with NFTs and the sort of craziness that is surrounding these as well. The metaverse as well is a huge part of the story at the moment. Facebook has just rebranded and said they're focusing on it. Microsoft has made a similar announcement, and we've seen big gains in the coins that represent those spaces as well. We've then got sort of events outside of the technology itself. So El Salvador adopting Bitcoin as national tender is a really big deal. It might be a small country, but it represents a big evolution in how the usage of this has advanced. You know, it used to be that Bitcoin was only for computer geeks, then it was only for criminals, then it was only small companies, now it's only small countries. This is moving sort of very, very quickly. And I think with all of these advancements and raising of the profile, cryptocurrencies, digital assets generally, has firmly established itself as an asset class. And as a result, it's now firmly in the realm of investment firms, and investment is flowing as a result of that. And we're seeing the approval of investment products to go along with that. Most recently, the Bitcoin ETF in the US that was approved, and that was the second fastest growing ETF of all time in the US market. So the demand is there, it's an investment asset class. And then I think we've also got very supportive macroeconomic conditions as well. Persistently low interest rates, continual expansion of the monetary base, and we now see inflation being a real risk that people are generally concerned about. So this is affecting the mentality of everyday people, and they're looking for alternatives for things to do with their money. Crypto's profile's been raised, and it's a good alternative for that.
No, absolutely. The future emerging opportunities that are going to continue to grow in this space, where are they going to come? I mean, surely there can't be this infinite, these infinite numbers of coins that just keep appearing, that'll give you the chance to double, treble, quadruple your money. Surely this is a bubble, isn't it? I don't know. Where are these future emerging opportunities that are going to drive growth in this space, particularly given the fact it's becoming more mainstream?
So I think the future growth in this space really comes as we move up the adoption curve. We're still pretty early days. Think 1997, 98 and the internet. A lot of people innovating by experimentation, a lot of people trying different things, a lot of people trialing business models, right? Things that you can build on the blockchain, and do they get adoption and are they useful? As we move up that adoption curve from sort of very early adopters to, let's call them the early majority, you will see, I think, sort of network effects forming around these business models. So the next sort of scale of adoption, the next opportunities are really going to come from the real world use cases, mass market use cases coming out of this technology, coming out of the uses for it. I think we're going to continue to see innovation in how people use it. But the idea that I think we're in a bubble right now is not correct. Are we going to have 5,000 coins that everybody interacts with regularly? No, of course not. So we're going to see some concentration around protocols, but different parts of the ecosystem will add value to different people in different ways. And I think we're going to continue to see that evolve. Decentralized finance has proved its merits. It needs to evolve. It needs to go to mass market. But the concepts there are very, very powerful, and I think are going to be very, very impactful. NFTs is another one that I really think is not going anywhere. You could very credibly make an argument that there's somewhat of a mania or a bubble for NFTs that represent pixelated fine art, to call it that. But a representation of a unique piece of value on a blockchain is going to be hugely powerful. Think if you could hold the deed to your house on the blockchain, it was instantly transferable, completely removed the friction, and it didn't take you 3 months with lawyers to sell your house. It took you 45 seconds with your smartphone. That's going to be a huge innovation that does something. That's what NFTs can do. So this technology's still got a long way to go, and I think it's really going to start to impact people's everyday lives.
That just sounds crazy, doesn't it? To be able to sell your house in 45 seconds. The NFTs. I mean, I'll just ask you this
Sure.
brief question about NFTs. To someone who doesn't really understand them,
Yep.
okay, which is, I've got a limited knowledge of NFTs. I understand the art side of it, and I can see that within a digital space, it's just like Picasso and pottery, isn't it? It's like it's finding new ways to express yourself as an artist. So I can see that, and I can see it within the music world as well.
Yep.
I think it's an interesting concept. But just tell us, what does it mean?
Yep.
And how does it work in the respect that you've just mentioned about, in the future you could put your house deeds out there on an NFT?
So I think you need to separate out the technology of what an NFT is and then sort of what it's representing. So the technology really is an ownership certificate, right? How do you express ownership of something that is unique? Whereas like Bitcoin, there are 21 million of them at max, and they're all in essence the same. They're fungible, all 21 are identical. But an NFT is unique. It's not the same as any other NFT, and it represents ownership of something. Now, a lot of what people are buying and selling at the moment are NFTs that represent digital art. A lot of this 16-bit computer-generated graphics that people have. But that's interesting that people want to buy and sell that, and that probably speaks to the internet culture that's surrounding the very early adopters of crypto. But the concept of unique value represented on a blockchain with increased characteristics of transparency, of ownership, of transferability, that's really powerful for any type of value that's truly unique to you. House deed is one example that I mentioned, but think employment benefits, think healthcare, think all of the value that you've got trapped in prepaid accounts or frequent flyer miles or anything that is uniquely valuable to you, your credit rating as well. It doesn't actually need to be something with monetary value. But if you had that in a way that was accessible, that you could always view, that you weren't dependent on a company to maintain your records that may or may not be in business in 5 years, something that's truly important to you, that you could own, hold on a blockchain address, have instant access to in perpetuity on your phone, that's going to be very powerful. Exactly what we do with all of that in all those cases, I of course don't have a crystal ball, but I know the idea of you having more ownership of the things that are valuable and unique to you is powerful for people everywhere.
I remember the first time it came into my attention was around the sale of the first tweet by the founder of Twitter, and how does this work then? It goes. It's almost like one of these auctions, isn't it? It starts at 0.01%, 1 pence or whatever, and then can go up to whatever somebody wants to bid on it. Is that sort of stuff? Is that kind of thing sustainable?
Look, I haven't got a view on what the right price is for a piece of art, for a collectible. I don't know what a Picasso's worth. I don't know what a signed David Beckham jersey is supposed to go for. I guess the market sets that price. There's a lot of excitement about things like Jack Dorsey's first tweet or some of these pixelated art projects, and probably a lot of them have sold for inflated values, and that will find its footing over time. I'm less interested in the short-term price volatility of these things, much more interested in the technology impact over time. And for assets that are more well-established, simply NFTing them doesn't introduce this price volatility. It just means the ownership certificate is more transferable. So you're probably right. There's a bit of hype in the digital collectibles space right now, but it's just such an exciting use case for the technology.
I think that's thanks for going into that. I think it's a really interesting topic that we'll maybe discuss further in our panel.
Yep.
So, how can an institutional investor gain exposure to this growing space?
So there are a few options open to people, right? And it really will depend on what you're looking to do, how you're running your portfolio, how active you're looking to be, how deep in the space you want to go, what's going to make sense for you. Really, you've got three options of how you can go about doing that, right? So one is take the exposure directly, right? Go and set up an account with one or more exchanges, set up a custodial arrangement, and go and buy these sort of natively. Secondly is go through the futures market. It's been a kind of growing route and has benefits for certain types of investors. And then the third is through sort of investment vehicles, right? So either funds or exchange-traded products, exchange-traded funds. Now, as I say, what you're looking to do will dictate what's the most appropriate route. If you're looking to run, if you want to get involved in sort of the very deep part of this space, if you want to be buying 150 different crypto exposures, you want to be trading these frequently, going directly to the market is going to make sense. If you're running a crypto hedge fund or an active shop, or you're trying to manage your portfolio in that way, that's going to make sense to you. If you're coming in a more moderate way, like it's part of a multi-asset portfolio, it's an asset allocation, a relatively small part of it, then the operational effort associated with doing that is probably not going to be worth it. The crypto world and the traditional investment space work very differently. You need to pre-fund a lot of accounts. You pre-fund all your trading at all of the exchanges. Custodial arrangements are very, very different. Running due diligence, doing your compliance reporting, doing your risk oversight, your fiduciary management. The workflows are just so different. They don't mesh. You need to build new processes. You need to build new systems. So time commitment, it's a capital commitment as well. But if you're looking to allocate big chunks of a portfolio, you're looking to be very active, that's probably the way to go. If you're looking to do this on a longer term asset allocation, smaller portion of a portfolio basis, then one of the access products is going to make sense. If you're looking to do something on leverage, if you're looking to trade short term, if you're looking to go short, futures, probably a very good option for you. For the long-term investor, they tend to come with a couple of structural issues. So one is that there's roll cost associated with them. Without being too technical, futures, Bitcoin futures are typically in contango. So there's a negative roll cost associated with them that can run at circa 10% a year. So that's a big drag if you're a long-term holder, as well as the operational impact of actually rolling that every month. All the liquidity's in the front month. There's also an issue with capacity. So you can only buy, a given portion of the futures market at any kind of time. These are sort of holding limits imposed by the regulator. And if you're doing something that is trying to be mass market, this can actually be a concern for people. We're starting to see it become a concern for the recently launched Bitcoin ETF in the US. Nothing new. This happens for every other kind of futures market. It's if you do nickel or tin or oil, these can be problems as well, but it's just unique things of futures. So if you are going longer term holders, long only, I tend to think that exchange traded products are the way to go for institutional investors. They provide the most direct exposure and come with sort of the lowest kind of price point. I think the benefit of ETFs for any asset class, Bitcoin, Ethereum, other cryptos included, is that they sort of simplify and standardize the route to market. It fits in with everybody's existing product processes, with their compliance oversight, with their reporting, with their dealing flows. Lets them trade on regulated venues against regulated counterparties in a way in which they're familiar with, but focus on sort of what they're good at, which is asset allocation and providing that asset allocation to their end clients. And really that's what the vehicle is there to do. I think the stage that we're at in the market, that's a really powerful tool, because people are really still looking at dipping their toe in the water. I'm not expecting pension funds to have 25% allocations to Bitcoin at this point in time. We're really talking about single digit allocations, in which point something that fits with your processes is what's going to make the most sense.
That's a really good answer. Well, one of the things that I'd like to ask you, and this is something that I think is at the forefront of people's minds when you talk about cryptocurrency. We're talking about risks, concerns. So the short question is, what are the risks and concerns for institutional investors? But one of the I'd like to make a small point at the outset. One of the things that struck me around the crypto world is the manipulation that's possible within this. Being at the behest of a billionaire, it's like a billionaire's plaything. We're talking about Elon Musk. We're talking about his kind of, playing with is it Dogecoin? I call it dog coin, or it's got the dog. It's kind of this. Shiba Inu. Yeah, this kind of joke thing, where people have made a lot of money with it. It seems that being at the having someone as mischievous as Elon Musk, that's able to send the prices rocketing and plummeting, doesn't feel right. We're talking about risks and concerns. I'm an institutional investor. What do I need to keep in mind if I'm looking to get into this space?
Okay, so I can. Let's talk about the point around manipulation and Elon Musk particularly, and then we can talk generally about the risks. So you're right. It's not good when people have outsized influence on a market, and it's definitely not good when they exert it. We know that that's not something that in sort of well-established markets that we want to see. So the propensity of a market to react to anything like that is typically a derivative of the size of that market. Any individual's ability to have an impact on the S&P 500 is hard because it's big and it's heavily traded, and you have to put a lot of capital against it to do it, and the amount of capital that follows any one person's opinion is relatively small, more established markets. Crypto is relatively nascent, but it's not the smallest market in the world. It's not the most reactive one. If you compare it to small commodities, things like tin, live cattle, lean hogs, if you compare it to small cap equities, private companies, startups, IPOs, they behave in similar ways. You just hope that the people involved do so in a way that is consistent. Elon Musk tends to carry on a little bit in public. It's not new for crypto. He's got in trouble with the SEC for doing the same thing with Tesla's share price, and he got removed as chairman as a result of that. So this isn't a crypto thing. This is an Elon Musk thing, and it's great that people that are world-renowned technologists are looking at crypto. I love that Elon Musk is there and involved. I do wish he was a little bit more retrospect with his public comments when it came to sort of anything that has a market around it. That holds true for Tesla as well. But the market's ability to be manipulated generally is only going to decrease over time as liquidity goes up, as we see for any asset class, anything that has a market around it. Small cap equities are typically very beholden to what the president of that company says, what the CEO says. And you just, generally hope that they are well behaved. But it's not a unique thing for crypto by any stretch. I think this sort of tends to talk then more generally about the risks that people consider. I mean, I'm asked a lot about this question, about the potential for manipulation, about outsized personalities, about the volatility, about the uncertainty of path to adoption, about the regulatory headwinds that the space might face. And we can talk about that in as much detail as anybody would like, but the problem with that conversation is I think it's very backward looking and it's very pessimistic. It assumes sort of negative outcomes. And I think that thinking that way is a risk in and of itself. The real risk for institutional investors, I think, is the opportunity cost or the risk of not being involved in this. This is a truly transformative technology. This is going to do to the transfer of value what the internet did to the transfer of information. And this is a big deal. If we sat there in '97, it was almost impossible to predict that Apple, Google, Facebook, Netflix would exist in the incarnations that they do today and the impact that they would have on the economy and the value that they would retain. It's sort of very similar to sitting there in '97 and saying, hey, where's the internet going to go? Information technology today represents about 30% of the global equity space of value retained within that network. It represented essentially zero in 1990. We can debate what IT is, but it's pretty much all been driven by the internet as a technology. To not be involved in something in a moderate way with a technology that is, I truly believe, as inevitable as blockchain is and as inevitable as the development of the crypto markets are, missing out on something that could be 30% of value in 20 years' time really feels like a missed opportunity. And potentially worse is there's a risk that you lose relevance with your client base by not providing them access to it. The idea that people want this is done. The horse is bolted on that one. The FCA did a survey, 2.3 million adults in the UK have exposure to crypto. They want it and they're going outside their usual channels to get exposure to it because their advisors, the asset managers they use, the pension funds, their SIPs, it's not available in that. And if you want a competitive advantage for the next 10 years, be an early mover in this, be an adopter. And I think the real risk for institutions is being left behind.
No, absolutely. I'll just staying with the risk, because these are questions, like you say, you're going to be asked all the time. Yep. One of the what about the geopolitical side of things?
Sure.
And in particular, China, who China has tried to control this market.
Yep.
Countries like to exert control over the people, over the money, over the flow of assets. Mm-hmm. This is how the financial services world like to control these things. This seems to be something that it's a disruptor, right? So mm-hmm. It's quite scary for some governments to think that, wow, this is a decentralized currency that is getting traction. Isn't it possible for them to just shut this down? Is that not the biggest risk of all?
I don't believe so. China's done a pretty good job of it, right? I don't think anybody will follow China's lead on all things that relate to restriction of your population. People don't follow China, and that's exactly what this is. Their willingness to exert control, their willingness to censor the internet, like there's the Great Firewall in China. No one else is going to put that up. We're not going to censor free speech in that way in the Western world, and that's really what you'd have to do to control it. I've already mentioned 2.3 million UK adults have exposure to crypto in some way. You have to bring enforcement action meaningfully against them in order to properly control this, because this is something that can just be accessed on the internet, and people want it. And so I think the horse has bolted on that one. Like, the demand is there, people want it. And what I see from regulators, the noise that they're making is that they understand that they are trying to take steps to bring crypto-related activity under the regulatory umbrella. They're not trying to push it out because, again, it is obvious that that's not really feasible. It's not really practical. But they do also recognize the power of the innovation, that there is value in the efficiency that this can bring to the market. My view, personally, is that regulation is going to play an important part in bringing crypto, in bringing blockchain, and bringing DeFi to the masses. It's going to be a huge part in building trust with the general population in the systems that are getting built. Now, if you talk about a given jurisdiction, how helpful or how much you may be slowed by regulation is going to depend on the nuance of the implementation of that regulation. But it is going to be allowed. The innovation is going to continue. It will move quicker in some economies than others. This is sort of the natural capitalistic experiment that we have going globally, where someone will do something one way, some will do it another. You'll see that it works really well in one jurisdiction, and the citizens of another will want that to be adopted. And I think because this technology has the potential for improving efficiency in access, in democratization, to use sort of a cliche, of financial services, I think it can improve those things by an order of magnitude, meaning that gains made from this won't stay isolated in a given geographic region or a given country for very long.
Well, really good answer. Jason Guthrie, what a pleasure to talk to you about about this very important matter. Let's see where it develops over the next few years.
Thanks very much for having me.
Thanks for your time.